Welcome back. You're tuned into Bazaar Morning Call. Well, Deven Choksey, MD at DRChoksey Finserv, joins us on the show. Hi, Deven. Good morning and good to see you in. Well, let's talk about the big mover yesterday. Reliance Industries came out to bat and helped the Nifty, smash it out of the park. What's the view of the stock? You have that additional technical trigger now, which will be a bonus issue. Tell us more.
Yeah, Nigel. Good morning. Well, of course, the bonus issue is one aspect, and definitely I think this is an important one. Largely because of the fact that I think most of the businesses have completed the capital investment cycle to a greater extent. The last one, which is the renewable segment, I think is undergoing the implementation. So I think by next year, they would also be by and large finishing the, I think, larger part of the capital investment cycle. So obviously, on a 6,700 crore equity and on a 7 lakh crore worth of reserve, it's a no-brainer as far as I think the issue of bonus is concerned, because the serviceability of the equity is never in question in this kind of a situation. With more than 1,60,000 crore worth of EBITDA producing, which is growing at around 15% on a yearly basis, I guess I think it's given that I think this kind of bonus will get easily absorbed as far as I think the company's operations are concerned. More importantly, I think capitalizing the reserves at this point of time also gives an indication that somewhere down the line, I think the company is preparing itself for demerging the retail business as well as the geo platform business. Because I think generally when you capitalize your reserve, at that time you give an indication to the investors that yes, I think you have completed the program, and now I think the businesses which are going to be separately listed, they will probably find its own way. I think that is an indication in between the line message that one can read out of it. Otherwise, I think from the annual general meeting, I think a couple of things which I think has appealed me most. This company is trying to disrupt its own business model by way of creating a similar kind of an impact through implementation of AI and deep tech technology in their entire operations. This is probably on the size of a company like Reliance, I think is not heard of, I think very commonly. I guess I think this is what they're challenging themselves, that before the competition or global play could possibly swipe them out, they are actually, I think, preparing this company for a long-term play, I think, with a sustainable operations. So that, I think, remains, I think, a cornerstone of the entire AGM speech. Apart from that, I think every 3 years, 4 years, retail business and geo platform business, they have indicated that I think they will grow double in size from what they are currently. So 90,000, 1 lakh crore kind of EBITDA between geo platform and the retail stands doubled, I think, 3 years, 4 years from now to 2 lakh crore. And I think that's an important key takeaway, along with the renewable segment, I think, contributing as much as I think the O2C segment contributing today in next 5 years. So I think they are creating a vision of at least 3 lakh crore plus kind of an EBITDA making business for the company in the next 3 to 5 years time.
Deven, good morning. How would you look at some of these fundraise efforts, especially in the real estate space? Yesterday there was that rich list which was put out by Hurun, right? And it was noticeable that real estate companies and promoters of real estate companies were some of the maximum new additions, I think, came from that space, from real estate. And I think that talks to the boom that we are seeing across the board. Most of course, the value of most of the people on that list is tied to stock holdings, the underlying value of the shares they own in their businesses. But Prestige Estates, Max Estates, both doing a fundraise round. Max promoters themselves are also putting in money along with outside investors. I don't know if you have any views.
Yeah, Prashant, good morning. Well, as such, I think that this is an asset class. The real estate as an asset class is basically a class which is going to be due for next 25 to 50 years kind of development in the country, which is happening. They are likely to be, I think, participating significantly into this particular development. So if you are an entrepreneur, if you are owning the real estate company and probably, I think, growing into this particular mode of providing the business solutions across the country, then probably I think is the best time that one can argue for. In my viewpoint, I think business remains capital intensive for a reason that I think for expanding the operations, you continue to have larger amount of capital, and so would be the number of square feet I think that you construct. You require that additional capital. So I'm not completely surprised that I think some of the promoters are also, I think, raising money or deploying money in some cases because of, I think, this particular reason. In my viewpoint, I think the valuation-wise, if you look at most of the companies, they are adequately priced today. But if you are having patience to stay invested for next 3 to 5 years, then some such opportunities will come in between the times when I think you will get some of the corrected valuations available to you. So it's a long-term play as I see it. I think in the near term, most of the things are appearing in the price at this point of time.
Since Deven, I was talking about Tata Motors, right? Yesterday, there was a big surge on the stock, 6% higher, as the company goes through a lot of the corporate actions, including the changes in the share capital itself and, the DVRs, which will be on their way out. Can you just simplify for us exactly what's going on and what is it that shareholders should keep their eye focused on?
Yes, Urvi, I think this is slightly a tricky question from the point of view of taxation impact, I think, which is coming up. The DVR shares are getting converted into the ordinary shares, and today is the last day of trading. From 1st September, that is Sunday onwards, I think these particular shares would be, I think, getting traded into the normal shares. Now, if you look at, I think, the impact coming in, I think the DVR shares basically converting to ordinary shares, there were three legs of taxation out there. The first leg of taxation is that I think whatever the number of shares, 51 crore shares of DVR, they are basically going to be attracting the deemed dividend because of the free reserves that is there in the company. So as per our workout, on about 10,000 crores free reserves, I think it is about 200 rupee per share kind of an impact coming in. So this 200 rupee per share would be considered as a deemed dividend in the hands of the DVR shareholders who are basically converting their shares into ordinary shares. That is the first leg of impact. So deemed dividend would have its own taxation impact at the same time. Then the company is forming a Tata Securities Trust, I think, in order to basically settle the TDS part of the deemed dividend, which they have to deduct before making the payments. They will probably deduct the till 10% TDS, and that is where probably I think they will have to sell some part of the shares allotted to the DVR shareholders. So that will probably result into the reduction in the ratio from 7 shares of Tata ordinary shares of against 10 shares of Tata DVR. It will further reduce some part of the shares. So that is the second level of taxation impact. The third level of taxation impact, as I see it, is in the hands of the investor. When he is basically getting the converted shares, he is attracting long-term capital gain tax in case they are holding for more than 12 months. So I think these three legs of taxation is there. Of course, I think the deemed dividend tax will be first deducted out of the price, and then probably long-term capital gain tax will be calculated. But as you can probably make out, that it is a very weird way of, I think, working out the entire thing, and probably I think taxation structure is quite complicated. In my understanding of the subject, it is best that I think the investors would allow the shares to get converted into the ordinary shares and end up, I think, taking the taxation part on the other side instead of, I think, selling the DVR shares today in the market and buying the Tata Motors shares on the other side. That may probably result into unnecessary amount of cost, I think, that they may incur. So I think the first option is better. Allow the DVR shares to get converted and let you get, I think, the Tata Motors ordinary shares in course of time in next 15 days after the book closure is announced.
Okay. All right, Deven, that's helpful. Thanks very much for for simplifying what seems to be a fairly complex exercise as the DVR shares are phased out. Thank you for joining in. You have a good day, and we look forward to connecting again.